All right, we are back. We are live and ready to go. So we're going to talk about short selling, which is a term you both heard, but the actual mechanics of short selling is something that's important to understand. So every major broker is going to have an inventory of stock that they actually keep on the books specifically for lending out to clients that want to sell short. But here's a really simplistic example. So let's say, I don't even think I need the notepad, notebook, whiteboard, whatever, up right now. So let's say that I go to your house and you have a brand new bicycle in your garage. And it's like wrapped in plastic or whatever. It's totally unused, still has the label on it and everything. All right, brand new bicycle. And it was $1,000. And then I see an ad from REI or Bass Pro or whatever, or, Dick's Sporting Goods, I don't know, for the same bicycle, advertised on sale, 50% off Black Friday for $500. So I take your bicycle and say, hey, John Luke, can I borrow your bicycle? And you don't know what I'm doing. You just assume I just want to borrow a bicycle as a say. I don't know. But I borrow your bicycle and I go and I sell it on OfferUp or whatever, Facebook Marketplace for $1,000. Then I go to Dick's Sporting Goods and I, with the Black Friday coupon or whatever, and I buy your bicycle back from Dick's Sporting Goods for $500. And then I give it back to you. Do you follow?
Yeah.
What I did there? I borrowed something from you, sold it for a high price, and then I went and bought it back at a lower price and gave it back to you. So that's the same transaction that happens when you short sell a stock. So you borrow it from your broker. So say I want to short Apple. I think Apple is going to go down. So I borrow, shares of Apple from my broker, and then I sell them at, let's say it's at 100. I think Apple's going to go down to 50. Then at 50, we call it covering. I cover the short, which fundamentally that just means I buy the stock back at 50 and give it back to the broker. Now, when you short stock, it is because it is loaned to you during the duration of the time that short position is held. The broker is going to charge interest on the stock, and that might be like 10% a year, 11% a year, something like that, on the dollar value of the short position. And also, if you sell short, do you know how dividends work?
It's the payment that you get for owning a stock in a company as a shareholder.
Sure. So like if you own shares of Coca-Cola, every quarter, every 3 months, Coca-Cola is going to pay you a percentage of their profit for that quarter. And that's called the dividend. So, if the stock is at 100 and they have a 5% dividend yield, or the dividend might be, $5. So that would be 5% dividend annually. Now, if you are a short seller, by holding that short position, you become responsible for paying that dividend to the party who bought the stock from you. So one of the reasons that companies will have a high dividend yield is, one, it attracts investors, because higher dividend yield, that motivates buyers. Say, oh, I'm going to get paid, a dividend. If it's a high dividend, obviously everyone, that's good. That means you're getting more money for just holding it. But it also disincentivizes short sellers, because if you hold it short, you're responsible for paying that dividend to the person that you sell it to, that you short sell that stock to. So that's one tool that companies use to avoid having like a high short float. Short float just means the percentage of a company's total stock that is currently held in short positions. So like there was that, what was the menswear, not Men's Warehouse, J.C. Penney.
Mm-hmm.
I think at one point J.C. Penney, they're bankrupt now, obviously. But I think at one point J.C. Penney's entire stock float, I think 50% of the float was short, which is, really high. But do you guys kind of get short selling now? Like the actual mechanics?
Yeah.
Okay.
So you're borrowing something to sell it because you're planning on it being worth less. So you're going to turn the profit from how much you sold it for how much it's going to be worth when you buy it back. But I'm still confused. The dividends that you get paid if you're currently borrowing the stock and you get paid a dividend while you're borrowing the stock, you have to pay that to the person you borrowed it from?
No. If you borrow it and then sell it short, and it's a stock that pays dividend, not all stocks do, but if it pays a dividend, you are responsible for paying that dividend to the party that bought it from you when you sold it.
Okay, so if you get a dividend from Coke.
So that dividend is just coming out of the cash in your account.
Okay. So the dividend goes to the actual owner, not the borrower who's shorting it.
Correct. The borrower who's shorting it becomes responsible for paying it.
Okay.
All right.
So it's like an extra fee to make sure that not everybody's just going around shorting stock, because now they're going to have to pay out of their pocket the dividend for a stock that they don't even own.
Yes, exactly. It's an incentive that companies can use to incentivize people not to short it. That's one of the tools of having, or one of the reasons why a company might have a high dividend yield. Because it's a double-edged sword. Like on the one hand, they are incentivizing people not to short sell it, and on the other hand, the higher the dividend is, that's a reason for buyers to consider adding that to their portfolio or buying more of it, because they're the buyers are getting paid that dividend. So it's kind of a double benefit to a company. Now with derivative products like options and futures, short selling is a little bit different in that you're writing a new contract and you're not actually borrowing anything. So all of those rules I just said don't really apply with derivatives, but we're going to get into that in just a little bit. So going back, let me screen share here. So like, let's say that we are Goldman Sachs and we want to push this stock down. So we can short sell it. We don't necessarily just have to, we don't have to own it already to sell it. We can sell it without owning it. We can borrow it and sell it. So selling short. So in the example before that, we talked about what would happen if we just did a huge sell market order and we eliminate all the supply, or I'm sorry, all of the demand. We introduce a huge amount of supply to the market very suddenly, and we eliminate all of the demand between 100 and 95. Okay.
Mm-hmm.
And then as soon as one person comes in with a buy limit order for one share at 100, the bid just pops way back up, and we just had an average fill of like somewhere around in here, like 97.5. So what we actually would call that is that's what's called slippage, where the bid and the ask are like 100 to 101, but then our actual fill average price is like 97. That's like $3 of slippage. That's the term for that. I'll put that up here as well. Just to have it there. This right here, what we had here, that is slippage between where we think we're going to get a fill and where we actually get filled. That distance is the slippage. Slippage does not happen with limit orders. Only with market.
Would you say it was the distance between where we think we're gonna get a fill and where we actually do?
Yeah, essentially, because with a market order, we're guaranteeing ourselves a fill, but not guaranteeing a price. So when we don't have that guaranteed price, anything that is beyond the bid in the case of a sell market order, that's slippage. So in this case, we would have had our average fill would have been about here. So we'd have $3 of slippage. So if we're a big bank and we want to push this thing down, all right, how would we go about doing that? We got 20 buyers. 20
you
buyers.
buy all the shares in between where you actually want to sell it, and then
all right, we're here. What do we do if we want to push this down, and we don't want it to just instantly pop back up as soon as one person puts in a buy limit at the previous bid of 100? So how do we push this down? We can't do it all at once. So how do we do it where it actually stays, where we're not just knocking the bid down for a second and then letting it pop back up? We want to actually push this price down, both the bid and the ask price. We want to push it down. How do we do that?
You put in sell market and buy market?
Well, no, that would just cancel each other out. That wouldn't really make any sense. We'd be buying at 101 and selling the same thing at, we'd just be losing $1 on every share. That, we'd sell it and then buy it, or vice versa. That didn't make any sense. We'd want to be doing sell limit and sell market. So we'd want to start off with a sell market order of 20. So now the bid price is here, and we want to put in a sell limit at 100. So
okay.
Now, then we want to push it down to 98. So we eliminate these people at 99, and then we put in a sell limit at 99. So we're saying we will sell at 99 or greater. So now the ask price is 99, and the bid price is 98.
So you're just going to switch everything to a sell limit after you
We
buy
need to do
all
a
of the.
combination, like that term that I had, hit and offer.
Mm-hmm.
We want to hit the buyers at 98, eliminate them, and then start offering, saying, I'm willing to sell with a limit at 98. So we hit it and then we offer, hit it with a market order, and then bring in a limit order to bring the ask price down.
At the same price that we just did our fill order at?
Yeah. So we've eliminated all of the buyers at 98. So now the nearest buyers are 97. So if we want to push this even lower, we go to 97 and do a market order to eliminate the opposing buy limit orders. And then we put in a sell limit to, again, bring down the ask price.
Okay, and so you are buying everything, saying that you'll buy it for, I'll pay X price or less. And then after you own those shares, then you switch it, and then you'll say, I'll sell for Y price or greater to everyone else.
Yes.
Now that you control the shares.
Yeah, now that we've eliminated the opposing supply, or opposing demand in this case, or it could be opposing supply if we want to put something up.
And because the market, most people are going to want to pay the least amount that they can for a stock. They're not going to pay more than your sell limit.
Yeah.
And so now you're actively pushing the price down lower.
Now let's say we do it again here at 96. And one more time at 95. Okay. Now we have sold at an average of 97 and a half. Like the average for our fill is like around here. That's the average price that we've been filled at, pushing this down. The bid price is down here. This is the bid. and then this is the ask.
So why would a company do this? What does this accomplish other than devaluing stock?
Well, you could do it the other direction, but the reason that you do this is to actually move price. So if we had accumulated a large position, a large short position, like let's say we put in a massive, like we had a huge sell order at 101. Let's change that to say it was 200, and then we let people keep hitting this with buy market orders until this market ran out of demand and isn't getting pushed any higher, because for the buyers to go above 101, they'd have to eliminate our entire order. So let's imagine that we've gotten, all right, let's say we have 200, we get 100 shares filled here, okay? And we get those filled because of opposing buy market orders filling our short position at 101. And then once our big position is filled, now we want the thing to go down. So we would use this to, if we were a big bank, of course, this would be an active trading party, not a passive trading party. We are going to be passive because we don't have the capital to move stocks around. To do something like this, it would take $5 to $10 million of capital at least to move something like $5.
So we're going to be in the middle there. So when a big bank or a big entity is moving the price, we're going to be caught in the middle.
Yeah, we want to ride the wave of their movement.
And we're surfers. We're not the tide.
Bingo. Exactly. We're just the surfers. We're not the tide. Goldman Sachs and BlackRock and Morgan Stanley and these guys, they are the tide. So, all right. John, how about if you screen share? What time do you actually have to leave?
I probably need to leave in about 10 minutes.
Okay, that's enough time to get Thinkorswim kind of set up.
All right. Well, let me pull it up and I'll start presenting.
Thank you.
Yeah.
I think Jonathan already got his kind of set up in paper money.
Yeah, the watch list. I just can't remember which ones we had.
All right. So they start you off with, looks like 200,000 of paper money.
Yep.
So for a first thing, I'll show you, let's talk about, you can set up like the privacy options. See up at the top where it says total all accounts. So in actual real Thinkorswim, real money, you can actually have multiple accounts linked to one Thinkorswim login. So you could have like a personal account and a business account and a Roth IRA and a 401k. And, you could have like, I think up to like 10 separate accounts linked to one login.
Gotcha.
So just select margin.
All right.
Right there. So each one, I guess, has 100,000. The balance there, option buying power, that means that's like that number there shows like your cumulative balance if you have all accounts selected or just the balance of the one account that you have selected. You see privacy mode there. When we're actually like presenting this in real, especially with a real account, you're going to want to turn that on because that hides your account number and it hides your balance.
Okay.
So that's a good thing, especially if you're streaming this, we're in paper money. That's not a real account number, so it doesn't matter. But it will definitely give you, a lot of, with real money, you probably want to have privacy mode on.
Gotcha.
Okay. So up here we have Trader TV. Let's start with that. You see those 3 dots with 3 dashes kind of looking thing?
Which corner?
Left, lower, where it says Trader TV.
Yep.
All right. You're going to want to delete Trader TV. Yeah, delete gadget. We don't need that. You can also do the same thing for quick chart and quite frankly, also for live news. Yep. All right. Now you select watch list. All right, we're going to go to create a watch list. Call it whatever you want. And then we see it says symbol there.
Mm-hmm.
All right. Click on where just below where it says symbol, where there's that black line. All right. Now type in SPX and hit enter. Now we're going to do the same thing again, just below SPX. Type in /ES. All right. Next, we're going to do SPY. Next, we're going to do VIX, VIX. All right. Now there's some longer ones. You're going to want $, ADSPDC.
Is that it?
And we're going to do one more as well. $, UVOLSP dash $, DVOLSP. And,
Spell that.
yeah, that's right. That's correct.
It says not applicable there though.
Yeah, that's
There it is.
yeah, that's right. It might say not applicable, but it's full of shit.
All right. Is that it?
Yeah, this is a good starting point. A good starting point to work with. All right. Now we're going to work on linking things. Let's go to you can use either the top tabs where you see it says monitor, trade, analyze, etc.
Mm-hmm.
You can click on those. That's like the slower way. Or you can hit control and then it's like 1 through 8. Yep.
Mm-hmm.
So that's the faster way. So like control 6 is charts. So let's hit control 6. All right. You see how next to where it says enter symbol, there's a number 1.
Yes.
And then you see on your watch list, there's a number 2. So let's just link those together so that your chart is synchronized to your watch list.
So sync it to a red number 1.
Yeah, either way, just as long as it's the same number, they'll be synced. Now click SPX on your watch list. All right. Now, what do we have? What are we looking at?
This is a monthly chart. Right?
No, it's the x-axis is showing months, yes, but you can see up at the top we have daily. See the D?
Okay.
So each of these candles is a day. So let's get your time frame set up. Let's set up some favorite time frames. So click on that.
How do I
D.
zoom out? I accidentally zoom
Double
in.
click. Anywhere on the chart. Yep. Well, let's talk about manipulating the chart also. You see down at the bottom right, you have the mouse.
Mhm.
All right. So with that, you can zoom in on specific things. So like the cursor type, when it's set to the arrow, the pointer arrow, which it is now, click on the pointer arrow. Not that. Yeah, there. See, you have the top 2. The pan, you can drag the chart left to right.
Okay.
So click on that and then just try like moving the chart. See, it's like that. There you go. Whereas if we go to the other one, the pointer arrow, click and drag and you'll highlight a specific area. So just click and drag across a couple of months. So you do that. See, now it zooms in just on that section that was like highlighted in gray when you clicked and drag. And then to zoom out, double click.
Gotcha.
and you can zoom in on an area and then switch to the pan tool to move more precisely within that area as well. So you can try that. Like you start with that with a pointer, zoom in on like a month or two, and then switch to the other tool. And that's the trend line.
Oh, I thought that was the.
That
This
one.
was the pan.
Yep. And then you can move around a little more zoomed in. It's actually very easy to do. Very easy to manipulate charts.
Makes sense. Why are the green ones hollow?
We can change that. It's just the default setting.
Oh, it is? Okay.
All right. Let's start off with time frame. Let's get that all set up. So you see the D up at the top next to the gear.
D next to the top. This gear?
There
we go.
Yep. Okay, you're going to hit the D, though. That's next to it. We're going to do that next, actually. We're going to hit the gear. But, all right. For our favorites, let's hit Customize List. All right. Let's click on the 20D 1 hour. Hit Edit. And time interval, let's change 20 days to 180. And hit Add. All right. And now on the 4 hour, let's change that from 180 to 360. All right.
And the aggregation period,
Same. Yep. And then on the 1 year, 1 day, let's change that from 1 year to max available. There you go.
And the aggregation period still the day?
Yep. That basically means, like, for example, the 180D 1 hour, that means it's 180 days of 1 hour count.
Gotcha.
And then on the weekly, let's also make that max available from 3 years. All right, these are going to be our favorite time frames.
Really, the 180 day, 1 hour?
Yep, this list here is like all of the time frames that we can just go to and then hit apply and OK. All right. Now when we click on that D, the time frame is going to be set up so we can just immediately go, like if we're looking at a daily chart and then we want to look at 1 hour, just click 1 hour and it'll just go boom, and we're straight to 1 hour. There we go. All right. And then here we can zoom in on specific areas and do that. Let's get the chart set up next with the gear there. Gotcha. Let's hit the gear. Let's go to let's see here. Under settings there, you'll see synchronized crosshair positions. Yeah, let's do that. I'll show you guys how that works. I meant to do that the other time with Jonathan. Let's also go to price. Just go across the top, those tabs at the top. Just go to price axis next. Obviously, don't need to mess with any of this.
Do we need to do anything to expansion area?
Yours is already set to 89 bars. That's interesting. Oh, that's fine. That's fine. 89. I usually use 100, but 89 is fine. That just means how many bars to the right of the current day it's going to show. Gotcha. Favorite time frames, already did that. Appearance. So you see where it says fill up? Yeah, hit that. Makes it snazzier. You can also like make the green like pop more if you want to change the green to a brighter green. You can do that, for example. Go to more. And you can pick like one in the middle there, but it's like a really banging green. Should you choose to.
I think I'm all right with how the green is
Right.
right here on
I mean, this
default.
is just, minor details. Also, if you want to make the background like pitch black, that's how it makes it crispier. I like that.
Yeah, it does make it easier to read.
And
the grid white.
no, white will actually, you want it to be actually a dark gray. The white will make it stand out too much. It gets annoying, I think. Equities. Let's go to that up at the top, please. Mm-hmm.
Show CNBC video. Are you kidding me?
Yeah, we don't need, that's for like earnings announcement. This is all good. Options, you can hit that. All good. Futures. Check off highlight extended hours trading session, please.
All right.
Okay. And let's hit okay.
All right. I gotta go. I'll be
All right.
back soon. Let me just minimize this, and I'll be back in the meeting soon.
All righty.
All right. See you guys soon.
See ya.
Well, actually, I think
All
I might just leave it on mute and.
I'll tell you what we'll do. You can go and just take your time with your appointment, and then Jonathan and I are going to do some actual like orders stuff that we already got into a little bit, and then when you get back, we'll go over everything again, and I'll teach you how to set up orders, and we'll just start working on mastering the platform. So,
All righty.
We'll see you whenever you get back.
All righty. Bye.
All right. Now, if you could please also now begin screen sharing.
Okay.
And we're going to practice actually getting into some orders.
Sounds good. Present. One thing. All the other things were set up, just the custom list for the time frames.
Yep. No, that looks. I changed it to 360.
Okay. Where's that?
1 hour. Hit edit. We got to select 1 hour. No, that's the 1 minute. Go to like close that. What's see on the left? You see 180D, 1H. Edit. And then change that from 180 to 360. Just to get a little more data. All right. Let's do that. And okay. Very nice. Also, we need to add the high-low activator. So go to studies. Edit. And you can just search high-low. No, that's right in code. But there you can search high-low. Just type in HILO up at the top there in the blank search bar, or add it that way. Yeah, if you found it. Okay, good. Add selected. And then go to settings, and we want to set that to 21. Upright. Right. There you go.
The length?
Yeah, 21. All right. We're in business. Okay. Now let's go look at today. Where are we today?
Today is 125.
We can scroll with that bar on the bottom too. Over to today's yeah, right there. You can pull that over if it'll let you. There we go. All right, let's zoom in on like the last couple of days. Yeah. All right. What trend are we in overall here, would you say?
Upwards trend.
It would appear that way.
Mm-hmm.
So let's look at the ES too. Let's see the ES.
The what?
ES/ES. Hit that on your watch list.
Crown?
These are the futures, which are going to show 24 hours of data. So let's zoom in also here, and let's see if the high-low is saying, and it's still in an uptrend. Okay.
Uptrend. Yep.
Well, let's just put in a long and see how it goes. So let's go back to SPX. You're highlighting it, so it's not. You got to click on like the numbers. If you click on the actual letters SPX, it'll highlight it like you want to type something in. Perfect. Yep. Well, now trade is still set to a 2 or set to 1, so it's not going to link. So you can just type it in there on inner symbol or link it either way. All right. Let's go to 1 day out. Change the strikes, like make it 50. Just type in, Okay.
So
Now-
this, the in the money, out of the money, and yeah.
The blue is in the money.
Okay.
Black is out of the money. Left are calls, right are puts.
Okay. And then if I'm not mistaken, this middle line here is
Mm-hmm.
oh, it's
It's at the money.
on the money, at the money, yes.
Yep. All right.
Where exactly is at the money? It's that line in the middle, but
Yeah, it's like the nearest to being in the money. We'd say is
Okay.
at the money.
okay.
The nearest one.
Nearest to
Oh.
being in the money. Okay.
So we can see here that S&P is at 48.73. So let's right click on the 48.75 calls. And we're not in the middle. We got to go to the left of the calls. Yep. All right. Right click there. Well, that's just a single. So you can delete that. Delete is on the bottom right. And I'm going to right click there and go to buy vertical. All right, so this is a 245 debit. So let's right click and on this and go to analyze trade, and then risk profile up at the top. Green thing, risk profile, just above where you're at. Yep, perfect. All right, let's start off by unlocking that limit price down there. Next to those are the volatility adjusts right there. Price, unlock that. Now this is looking 235 is perfect. So let's just double click just below debit and actually send this order. So just anywhere that's not clickable on that order, double click, like on
Here.
where it's debit.
Oh,
for
on it.
Yeah,
on it
on
here.
it. Yeah. And hit confirm and send. Maybe you have to, yeah, okay, yeah, just hit send. And then the beautiful chime.
Oh, okay.
All right. Now let's go back to trade. And let's go to the January 27th, I think. 29th? Yeah. Okay, 29th. And let's go down to, remember, for our hedge, we want a delta less than 20, but more than 15.
We're
Oh,
still
we didn't add delta. We got to do that. I mean, I can just pull it up on mine and tell you what strike it is, so we can do this quick first. Boop. 29 Jan is a 48.35 delta. For 48.35 is a 19 delta. So go to the puts, 48.35. on the put side. Yep. And right click on 48.35 strike. Yep. And then go to buy vertical. That's going to get you a call if you do it in the middle. You got to be on the put side. There you go. All right. Now that says 90 cents. That's kind of high. So let's bump these down from 48.30 and 35 to like 25.30. So let's look first at, see the one there that's 48.35 on our order bar. Or actually, it'd be quicker probably to just go to the option chain and then check 48, like where we right clicked and created the order from the option chain. Just do that again, but a strike lower.
Right here. So here.
So yeah, we want this to be around 60 to 70 cents. 85. All right, let's go one strike lower.
25.
Yep. All right. Beautiful.
70,
All right. Analyze trade.
65.
Yep.
70.
That's perfect. That's perfect.
Okay.
Actually, you can just confirm and send right now. All right. Now let's go to our Analyze tab. This is going to be what we spend most of the time looking at. Now let's stretch that out a little bit. Remember how to do that?
Where do you go?
Bottom on the price axis, S&P price axis. I mean, other way. Oh, other way. To the right, and then pull the chart to the left. So we can get it like really. So we're seeing like just the space between like 4,700 and 4,950. Like, so do it one more time. Pull the bottom to the right, and then the graph to the left. Yep, do that. And one more time on the axis there. All right, now let's put it right in the middle. All right. And if it gets jerky like that, just switch the model type. See model where it says Bjerksen-Stensland.
What? What'd you say?
The Bjerksen-Stensland.
What?
Right at the model at the bottom.
Oh, okay.
Okay, you can just switch that to
Same.
black holes. Those basically are just different mathematical
Okay.
formulas to arrive
Okay.
at the same thing.
Yeah, they're last names. Okay. I
Yep.
was like, what are you saying?
They're all last names, yeah, except
Yeah.
binomial. That's not, obviously. I don't think. And then let's reset the slices. Do you remember how to do that? Next to the plus, the three little dashes.
Where is
On
it?
the right, on the right, on the right, down, next to the plus. Next to it, next to plus, there. Show actions. Yes, yes, yes. Reset slices.
So what is the reset slices?
Well, that's now it shows that gold line in the middle. That's representative of where the market is right now.
Okay, so like real time. Okay.
All right. Now we're going to go to price slices on the left, basically opposite side of where that was. Yeah. And let's adjust that from like minus 10% and plus 10% to plus 1% and minus 1%.
Plus 1, minus 1.
So now that these slices, you can see the delta, gamma, theta, and vega, and the open P&L of what it would be if the S&P were up 1% or down 1%.
Okay.
You see that?
So
And that-
here up 1%, here down 1%.
Yeah. So we can see here very clearly that if the S&P goes up 1%, you can see P&L open, because this is a long position fundamentally.
Mhm.
Our open P&L would be 1674, because this is 10 contracts, 10 contracts long and 10 contracts short, hedging at a later expiration date.
Okay, and PNL stands for
Well, P/L is profit and loss, and it says PL
Right.
open. That just means like like with an open position, that means it's unrealized. So
Okay.
unrealized meaning we right, like you can see right now the center strike where it says 0. It's not plus 1% or minus 1%. The center slice, slice. That one is where the market is right now, and we can see that the open P&L is up $49. So
Okay.
that's an unrealized profit essentially. Now it's saying, and that'll move around throughout the day. And as the market moves, we can also see the theta and the delta. So the delta, what that number means in this case, the delta of this position is actually how much this position is going to gain or lose per dollar of change in the underlying asset.
Okay.
So in this case, it's a long position, so it has positive delta. So with positive delta, what that means is if the S&P goes up 1 point, this position will gain, right now it says $34 in value. That's the position delta.
Mm-hmm.
Delta also works the same way on the option chain. So like when we talked about just a single long call or long put, and we're looking at like the, for example, I would say like look for the delta of 19.
Okay.
Like with what that means is actually let's go to the option chain for a minute. Let's talk about that. Talk about the Greeks.
Where's that?
Trade or control 2. And then all products. Yeah. Okay. So here, let's go to layout where it says last X net change. And let's add delta. Yep. Layout. Yes. And customize. And then just type in delta on the lookup, a column. Yeah, let's add that. Add items. And let's also add volume and open interest. Yep.
Open interest.
Yep. Add that one. And then also open interest. Perfect. All right. Hit OK. So if we look at like the one that's a 50 delta, delta is such an interesting thing because delta in mathematics obviously represents change. And the brilliance of the math behind how options are priced, delta is effectively both a measure of probability and also a measure of dollar value change.
Okay.
So
and dollar change.
So right here we can see that the at the money one 48.75 is a delta of 0.52.
Okay.
Right.
Yep. Mm-hmm.
Now, what is the leverage on options?
What?
I think you might want to plug in your device. I need to. Is it my device or
Oh
your?
yeah. No, it's mine.
Oh, mine too. Actually, all right.
Okay. I'm gonna do that now before it dies.
Yeah.
Quería estar y puedo cocinar.
Okay.
Very good. Okay. Let's go back to all right. Very good. All right. So we can see there the delta is 0.52.
Yep.
So you remember the leverage on options is 100x. So like if an option is priced at like there it says $18.80 is the ask on that call
Where's that?
right there. 1860.
Here.
Yep.
Mm-hmm.
That's the ask price. So that means that that's, you know, it's 100x leverage. So that's $1,860
Okay.
to buy that call.
Mm-hmm.
Delta, the way that works is if the delta is 0.51, that means times 151 or 52 now. $52 of change. So if the S&P goes up by 1 point, the price of that call will increase by $52. Or on the ask there, it'll add 52 cents. But 100x leverage, it's $52.
Okay.
And then you can see the one that's in the money. That one, the further it goes in the money, the greater the delta is, up to a maximum of 100. So
One.
Yeah. So 100. So the one that's 56 there, that means that every point the S&P 500, the underlying asset goes up. That particular strike, the 4870s, are going to gain $56 of value.
Mm-hmm.
And the further they go in the money, the greater the gain is.
1,000 would be one.
Yeah, like that one, that strike, if you held that call, every point the S&P goes up, your option's gaining $100.
Mm-hmm.
The other thing that delta functions as is also a probability gauge in a way. So 55 delta means based on the implied volatility, which implied volatility changes delta. So at the money will always be a 50 delta approximately.
Okay.
But the higher the implied volatility is, the higher the deltas will be further away, because what delta also represents is a percentage probability of being in the money. So this 4870, that's a 56 delta, that means that has a 56% probability of expiring in the money.
Okay. In the blue.
Yes.
Mhm.
And if we look at like 4920, that's a 17 delta, I think.
4920. Where's
Yeah, 4920 calls are 17 delta. So
0.17. Yep.
yeah, okay. So that means that as this goes up, the 4920s are gaining $17 per point the S&P goes up. It also means that there's a 17% probability of those being in the money.
Low probability.
If we doubled the implied volatility, which is Vega, which we don't need to add to the option chain, but this is just an important thing to understand. So if markets are, if the volatility goes way up, like we looked at the VIX chart where you could see like it would have those big spikes.
Mm-hmm.
So if we had a huge spike, if we had doubled the implied volatility, the 4920 delta, because the market's moving further, faster, with higher volatility, that might be a 30 delta.
Double or close.
Because there's a higher probability that it'll be in the money.
Right.
And then, to get to a 17 delta, we might have to go to like 4940 if we doubled the implied volatility. And vice versa, if we reduce the implied volatility, the delta at the money, will always be 50, and then it will drop off as we go out of the money much faster.
Mhm.
Does that make sense?
Yeah.
And it's so interesting how the mathematics of options, how they made something that is both responsive to where it's variable, where the value changes depending on how far something is in or out of the money, and where a change in the price of the underlying asset affects the price of that individual option more or less, depending on how far out of the money it is or in the money it is. And that measure is also a measure, a direct measure of probability. It's really brilliant, actually. And you'll also notice that with the delta, like if you go from a 50 delta to a 25 delta, the price drops off exponentially. So you can see that one, it goes from like, $17, $18 to 6. So from, if you cut the delta in half, it's like cutting the price by 60, 70%.
Yeah,
It's
like
like
24 down to 0.12.
Yeah. And then we go from a 25 delta to a 10 delta, and it's again about 2/3 reduction in price.
Yep.
So with options, there's no free money, like well, obviously, but everything is a give and take. So if you want higher probability, you're going to have to risk more.
Right. Obviously.
If you want lower risk, you're going to have to accept lower probability if you want to risk a lower dollar amount.
Mm-hmm.
So like if you buy something that's out of the money, your profit potential, your potential reward goes up significantly, because like if we buy something at like a 25 delta versus a 12 delta, you can see like that goes from what was it, like right around there. Okay, so from like between $6 and $7 down to like $2. But if we bought the what is it, 23 now? All right, if we bought the 23 and it went to at the money, the market goes up, so it's now at the money, and we wanted to sell it, we would be making about 3x. If we got the one that's at a 10 to 12 delta, we'd be making like 8x.
Mm-hmm.
So it really is this balance of risk and reward. Risk and reward and probability, where to get more of one, you have to sacrifice the other on paper.
Mm-hmm.
What we're doing here is, if you go to analyze, we are kind of bending the rules of option pricing in a sense, because we're using two expirations with different rates of theta. And in this case, we're getting a 50 delta. We're getting at the money, but we're also getting a between 2 and 3x return for something that's at the money. Whereas go back to the trade tab. If we bought at the money, that's what right now it's showing $17. How far would the market have to move for us to triple our money? Like if we assume $17 is the risk, we just use the debit that we'd pay.
Okay.
It would have to go to what, 54? Like right in there?
Between these two?
Yeah, so it would have to run
Pretty high.
like, 50 points. So we need a 50-point move to get a 3x. How about a 2x return? What would that be? Let's be realistic here. $35? $35. So that's 25 points to get a 2x return on a 50 delta. Now, if we go to the Analyze tab, where this is kind of cheating the rules of option pricing, with this, we need like 5 points to get a 2x return.
Just more like of the strategy that you kind of use, right? What you're kind of going through.
Yeah, and also with this, you're going to be able to watch it tomorrow as well and see like how this plays out and what time you can get you can start looking to get out. So we should also talk about closing orders. I don't want you to send a closing order yet because I want to pretend that this is like a live trade that we're actually doing with real money. Let's pretend. So closing, you're going to want to you see at the call side, call side. Down at the bottom, you see the index, and then it says calls. You're going to want to just drag the mouse over so you're selecting both of those. Hey, buddy.
Hello.
How are you, sir?
Good. Stopped for lunch. Met a friend. Now I'm back.
All right. Are you home in Savannah yet?
I am not. I've something better.
Well, John Luke is currently taking a quick break, so John Luke isn't caught up at all on options. He doesn't know anything about options yet. Jonathan and I did like a 7-hour crash course. That was pretty brutal.
It was a lot, but it was good. It was good.
For me, it was fun, but I felt like for you, I was like, oh my gosh, I'm wrecking this man's brain.
Dude, the first time I got exposed to options, I just did this was 2019, maybe a few years ago. But I did the TD Ameritrade education on options trading. I went through all of it, figured out all the Greeks. And then I bought this skinny book. Yeah, that was actually pretty decent. I mean, it gives you an understanding for, in general, what options are, what the Greeks are, what everything means. I mean, it's going to give you the good foundations, but it's not going to tell you like, and this is what you should do if you think that, stocks can go up. It doesn't really go into that. I then bought a small book that did basically the same thing, with some graphs and whatnot. And this book covered two different strategies that you can use with options. They're the two simplest strategies that there are. They're not very high reward. They're pretty low risk. Cash secured puts and covered calls, easiest strategies on the market.
Yeah, but that's until you get something that goes way in the money.
Yeah.
And
but the theory
20x reward.
Yeah, the theory with that is that you're trying to make a little bit of extra cash, but you're putting the strikes at a location which you're comfortable selling the shares. So yeah, you might have something that runs against you, but you're just gonna have to eat that. It's a matter of just eating it, and 90% of the time it doesn't run against you. It's just it's pretty safe though in terms of exposure.
Okay. I like what we do better.
Well, lower commissions is nice.
I mean,
but there is a higher upfront cost because you have to either have enough cash to secure those puts or have enough cash to buy 100 shares of something. Or standard is 100. Not every contract is worth 100 shares. But
yeah, that's kind of, all right. Let's go back to what were we looking at here? Okay.
Closing orders.
All right, yeah. So you're going to want to just click and drag over only the two calls down there on the black. Yeah, just over those. Yeah, just those two. Just click and drag so they're both highlighted in blue. Nope. Other way. Yep, like that. Perfect. And then you're going to right click. And you're going to go to create closing order. And you're going to go to sell. All right. Now we're going to look at this. Okay. Now go to the monitor tab. Go to working orders, open that. And then go to filled orders. All right, here's how we're going to do this. So we can see our fill here was $2.30
Where's that?
On the right.
Oh, here.
And it says it was a limit and it was filled at 230. And that's 48.75, 48.80 call. All right.
Yep.
So let's go to back to the Analyze tab where we were. And right now you can see that lock is open. So let's actually split this up a little bit. Let's do this will be good practice. We got 90, 85, 80, 75, 70. All right. Let's set the first one. Let's do this. See how it says 10 contracts there? Let's set that to, it says minus 10.
Mm-hmm.
Let's set that to minus 2. And you should be able to click the, we don't have the default order size set up, so that's fine. All right. And I'll show you some fast ways to do this. Now for the limit price, we're going to change that to $4.90. $4.
You start them off big, huh?
Well, because it's paper money though.
That's true.
And I only did that because the default quantity is 10 if you don't change the default. All right. Now we've got that set. We're going to hit confirm and send. All right. Now we go back to monitor. And we can see here, we have our filled orders and we have our working orders. The working order is just sitting there waiting for a condition to be met. In this case, that condition is for the limit price to hit $4.90.
Right.
All right. So let's also go, let's now right click on that order.
This one.
Yep.
Anywhere.
Anywhere. Yep. And go down to create duplicate order. And now it's going to have everything set the same. $4.90 limit, 2 contracts. So we don't need to keep, setting up a whole new order and selecting the 2 calls and all that crap. So this time, the only thing we're going to change is subtract 5 cents. So $4.85. And confirm and send. That's it. And you'll see what we're doing in a second. Now go to monitor. So now we have 2 orders for 2 contracts each with $4.85 and $4.90 limits respectively. All right, now right click on that again and hit create duplicate order because we're going to need to get rid of 10 contracts.
Okay. So anywhere here?
Yep.
Again, same thing?
Anywhere, doesn't matter.
Here.
And we're going to go to create duplicate. Now let's go to $4.80 on the limit. All right, confirm and send. That's all we're doing. And let's do it one more time, but this time, and if you hit the highest one, the 480, you'll only need to adjust it by one click. Let's do that, and then create duplicate order. And this time, let's make it 475. Because we're going to need 5 orders of 2 to get out of our all 10.
Other 10. Okay.
Yep. All right. And one last time with 470. All right. Now we do need to go through and change one thing I just noticed because we're putting these in today. So we'll go back to the others. Let's just send it. Just send it. Yeah,
Okay.
we got to change one thing though. There's the order conditions. So let's go back down again to the 490. The bottom one. Let's start there. Yep. And then hit cancel/replace. And we're going to make one change. You see where it says day right next to limit? Yep.
Where's that?
On the right.
Oh, here,
Next-
yeah.
Yeah, see day. Change that to GTC. All right. And then confirm and send. Day means that's like the order automatic cancellation. So GTC means good till canceled, like manually canceled by us. If you have it set to day, what would happen is that at 4 p.m. today, as soon as the market closes, all 5 of these orders would be automatically canceled.
Okay.
So we want these to be running tomorrow so that once it opens, our closing orders to take profit are still sitting there ready to rock and roll.
Mm-hmm.
We don't want to have to like re-enter all of these orders again tomorrow morning. So let's do that again with, all right, we've got the 490. Let's do 485 so that we just keep them in order. Do that day, change that GTC. Yep. This is actually really good practice though for order entry stuff, kind of getting the click orders, the order of operations, I suppose. Let's go. All right, 480 next. Yep.
So we're gonna do all of them, right?
Yep, all of them.
Okay.
GTC. Forgot to say that when we were first setting them up, but it's okay.
Where are we? 4
And 470 is the last one. Yep, perfect. All righty. Now let's go to our analyze tab because the market's now at 48.78. So let's see how our position is doing.
Our position. Talking
Well-
about the one you opened this morning.
Well, no, not that one.
Okay.
I mean, 48.78 is, we needed a little up, I think. We needed over 4,900 because we got in on the open. But this is different. In this case, we just got into this right now in paper money.
You're
All right. Let's zoom in really close so we can see basically just the where the slices are. Yeah, stretch that out. So on the bottom there, yeah.
Pull to the left or right?
Pull to the right. All right, and now pull the graph over to the left. All right, beautiful. And let's just change the Black-Scholes. Just change it back to the Bjerk's and Stensland, and it'll straighten out all these lines. Those are both both models. They display the same thing. Okay. So here we can see that it's our first strike, the 48.75 strike, is now in the money. You can see that's the very, very bottom corner of the blue line right there. That's our long strike. That's where we bought the 48.75 calls. And then the 48.80 calls are that's where we sold for our spread. Remember how the spread is composed of one long and one short.
Yep.
For a bull call vertical debit spread. That's what this is.
Okay. Bull call. Okay.
Bull call vertical debit spread. Now here we can see if this goes as high as 49.20 tomorrow, we would basically be what does it show? P&L would be like 17, 1800. Well, it'll show on the slice. It says 1794.
1794.72.
Yeah. Now click the day thing forward by 1 day there, which says 125.24 at the bottom. Not the bottom, just says date. Just over. Yep, right there.
Oh, here. Okay.
You click plus 1 day. Or you could hit the plus button there. It'll do it. All right, so that changed it just a tiny bit. But you can see here, like, what this would look like. This is, obviously this is 10 contracts. So realistically, you'd probably, like that thing of closing, by the way, in like in chunks from like ranging from 470 to 490 that we put in 5 orders.
Mm-hmm. Yep.
That's something that I would do if you're trading 10 contracts. If you're trading 1 contract, you'd probably just want to use 480.
Okay.
Which basically means like we don't like the highest price that the spread can reach is $5, but that's like you'd have to wait until expiration to get $5, and then getting 495 is really, really hard to do because there's so few people that are willing to buy it from you at 495 because it's like it's impossible for them to make any money buying it from you at 495. Like no one's going to pay that. So
Yep.
What we're doing basically with that is like we don't want like the blue line there represents obviously P&L at expiration, which I mean you can do technically. You can do that, but the thing is, I would much rather get like what is if we average if it's between 470 and 490, that's
480.
470 plus 490 divided by 2. Okay, so that's average. Yeah, that's an average of 480 across all of those. And 480 divided by 500 is 96%. Okay. If I can get 96% of the maximum possible profit on a trade by 11 o'clock in the morning, I'm going to take that every single time over waiting another 5 hours to 4 p.m. and risk it running against me to get that last 4% maximum possible profit. I'd much rather take 96% of the max profit home and be, I mean, there are plenty of times that Austin and I have been out at like 9:35, like we get a big gap in our favor and we're like done for the day at 9:35 in the morning. That happens more often than you might realize. And done for the day by lunchtime is also actually that's very common.
Half day's work.
Yeah. It's actually pretty, like if we have a winner, it's pretty seldom that we actually have to wait until like 1, 2, sometimes 3 o'clock in the afternoon to get a fill. Like it has to hover the underlying asset, SPX. It would have to hover like very, very near where our strikes are. So like if it, went up tomorrow, but it never went over like 48.90. Like if you can move the mouse just over 48.90, let's see, like that's, yeah. If it just stayed right there all day, that would be a day you'd probably end up waiting until at least 2 o'clock in the afternoon before you get a fill. Because click on the gear thing down at the bottom right. Let's just play with that because the vol adjust is going to allow us to simulate theta It's going to allow us to simulate time decay. So just press and hold the minus. Yeah, just click it and hold it. So this is what this position is going to look like as time decay happens. So you can see like this might be like, you know, around like a little after lunchtime. And then now it's, you know, like it's 1 p.m., 2 p.m. 3. So like you can see like if it was at 48.90, it would take a while before we get to and you can just reset that back to 0. But you can see at 48.90, we could be waiting all day in order to get a fill at that price. To get a fill at 485, 480. It would take a while. It's much easier. On the flip side of that, you can also see throughout the day the area where the risk is. So below our strikes in this case. That is also something that we need to be cognizant of, because that risk, you know, right now, it might be a maximum. Like this trade is like at face value, it's like a $2,000 potential profit on this trade. Like if we go, what does it show? What does it show the max is? Like 2,300 average?
Where's that?
It'll be like in the blue on the left. When you move the mouse over the blue line, it'll show it. Like in the money, it'll show it. Like right now it says 24. See there? At the bottom left corner of the chart, it has blue and purple.
Mm-hmm.
Purple is open P&L. The blue is P&L at expiration.
46.
Yeah. So if you look at like, if you move it to like 49.40, the mouse just over 49.40, it's like what, 2,100?
Yep.
Okay.
A little bit over, yeah.
All right, let's go like with the fact that we'd be getting only 96%. Okay, 96% times 2,100 is 2016. Okay, so we'd be this would be like about a $2,000 profit if we get it right with 480 average fill. If we look at the valley, the lowest point of that valley is 48.40. The lowest point like of the open P&L. So 600. So 700. Call it 7.
Yeah, 7, yep.
So let's divide that by 700. So this is a 2.88 to 1. As in our profit is 2.88 times our maximum possible risk at this time. Now, with theta, during the day, if our position remains out of the money and the market is at, say, 48.50, that could be perfectly fine, at 9:30. But at 1 p.m., that is not going to be perfectly fine, because that purple line wants to merge with the blue. So our risk where the mouse is right now shows 610. Mm-hmm. By noon, that will be probably at least double that by noontime tomorrow. So what we want to do is, if the market has run, if it's gone down, if it's run against us by about 10:30, 11 a.m. at the latest, we want to be out of this.
Sell. Yeah,
we want to sell both the calls and the puts. Now, why did we not put a limit order on the put side?
Why did you not put a limit order on the put side?
Yes. On the hedge, the puts, the 48.20, 48.25 puts. We did not put a closing order. Like we set up the closing orders for the calls.
Yeah.
To take profit.
Mm-hmm.
But when would we be looking to sell the puts? the hedge. Under what condition, what would have to happen? What would be going on when we say, okay, we're going to sell the puts? When would we be taking advantage of that? Like, okay, uncheck. You see the two puts there? Go to the left. Just uncheck those. So you can see here, in this case, if the market went down 1%, you can see how much the risk would be. Look at the minus 1% slice.
Okay. 18 this year.
Yeah, actually, there's a faster way to do what I just did, by the way. Check the puts off again. So it shows minus 2,000 at 1% down right now. If the S&P goes down 1% from here,
Mm-hmm.
that the open P&L minus 2,000. See that? At the minus 1%. There, yeah.
Okay.
Now go to check the puts off again, and then compare.
Check them back on.
Yep, put them back on.
Okay. 500.
That is a massive difference.
It's pretty big.
That is 4 times less risk. Do you
Okay.
see what we're doing here?
You're decreasing risk.
All right. Now, oh yeah, very much so. Now, actually, the easier way to do this is to see where it says all 2 series there on left. Yeah, there. Just click on that. Just instead of having to manually check each option, just uncheck the whole expiration date of the 26th. So let's just look at the hedge. All right. So what is our risk on the hedge in this case? Max risk. We can move the mouse over. It'll show on the blue line. So it is $600, and if the S&P goes down by 1%, our open P&L is plus 1,500. You see that?
Down here.
The minus 1% line.
Mm-hmm. Right here.
So that's almost 3x. So you can see how on the main check off just now hit select on the series, just select the 26th and eliminate the 29th. Yep. And get rid of the 29. All right. So again, that's minus 2,000 at 1% negative S&P change.
Mm-hmm.
And now uncheck the 26th and check the 29th. So do you see how that's working?
6.
That is up 1,500 at minus 1%. Another thing that I would note here is because this is a put, so this is a negatively correlated product. So if we look at the delta right now, it shows that the delta is minus 20 at the money, or where the S&P currently is. Yeah. Why is the delta negative on the puts? Why is it a negative?
Because the risk is low?
No, let's go back to the option chain then. Go to the trade tab. All right, if we look at we were talking about like deltas, how like a 50 delta, that's a 50% probability. And it also means effectively that every point the S&P goes up, that option, that call will increase in value by $50.
Mm-hmm.
So if we flip that and go over to the put side, look at the same strike on the puts.
Okay, it's negative.
That's a negative 50 delta. Why is the delta negative?
The price would go down.
Exactly. Yeah, that's saying that for every point the S&P goes up, that option will decrease in
By
value
50.
by $50. Yeah,
Okay.
exactly. So it means the same thing, but it's flipped. And by contrast, every point the S&P goes down, that will go up in value by $50, that option.
Okay. So then here, where was it?
So if we go back there and then we look at the delta on our price slices, the position delta, that means that as the S&P goes up, our hedge, the puts,
Goes
are
down.
losing $18 per point the S&P goes up.
Okay.
Now let's look at just the 26th on the series thing. Let's look at that just by itself and see what its delta is. All right. So its delta, we can see, that's gamma. Okay, its delta is $61. So the other one, it was losing $18 as the S&P goes up by 1
Good.
point.
So every time the S&P goes up by 1 point,
This
this
position-
gains this number.
Yeah, and that's like
61.95.
the cumulative delta of both the 48.75 and 48.80 calls.
Okay.
So that number is showing position delta, like the cumulative delta of all the options here together and our total position size, which in this case is 10 contracts. So if this were one contract, that would be $6.
$6. Yeah.
Yes, sir. That is correct. So here we can see, so it's gaining $61. Our position is up a total of $495. Okay. Just this one though, that's not counting the hedge. With the hedge, we're only going to be up about 350.
Mm-hmm.
So let's add the hedge. So we're seeing both together. All right. Yeah. All right. So what is our cumulative delta across all four? It's technically four separate positions because we're long 48.75, short 48.80 calls, and we're short 48.20 and long the 48.25 puts. So this is technically four separate trades in a way. A vertical is two separate positions
Mm-hmm.
in one. So what we're doing is we're setting up four separate trades that all work symbiotically together in a way. And we can see our cumulative delta is 44. Now let's talk about the theta, the time decay. So right now, it's showing that per day, where we are now, our theta is 1948. So that means that we would be gaining $1,948 per day.
84. Yeah.
Yeah. Now, if we go to the minus 1%, what does that show?
You'd be losing
All right.
$501 with 84 cents.
Right. So in all likelihood, we're going to end up with, like, when we open tomorrow, the purple line in the money. What am I saying? The purple line that's on the left, like our risk area, when we get into the valley of death. That's going to be tomorrow morning. It's probably going to be a little bit closer to about $1,000 negative area, which is fine because what we want to do is 2 to 1. Remember the coin toss example of 50 days we win, 50 days we lose, and when we win, we make twice as much as when we lose.
Right.
That's fine. We just don't want to be losing more than that, And if every now and then you go, you have it jumps a little against you, or you get in too fast, and maybe like instead of paying under $2.50 for your entry, you're paying $2.70 or something like that, where you have a little more risk than you should, and you end up losing, like in this case, where you don't want to risk more than 1,000. Maybe you lose 1,200. That can happen every now and then, but you don't want to be taking the main thing. I never ever ever want to see you do ever, or I'll be very disappointed, is take a max loss. A max loss is like if it expired on the blue line in the risk area, like a $2,000 plus loss. There is absolutely no reason that you should ever do that. Unless you're just throwing your risk management out the window and
Out
let
the
it
window. Forgetting about that.
Yeah, or Austin did once, but he was like, oh, it's way up. I'm gonna take a nap, and then woke up
Woke up. Tragedy.
and it was like down, like $500-600, something like that. It was like, yeah, you could have totally avoided that. Let's also talk a little bit about the risk management of this. So, if this were to go, if we were to have a big rundown in the morning tomorrow, let's say that S&P jumps down 1% from where it is now. Let's look at just the calls. So for us to realize that number there, right now it says 642 P&L open on -1%.
Where's it? Yeah. 606.
Yeah, 600.
Yep.
Call it. All right. For us to realize a loss of only 600, what would we need to do? Like, let's first just look at only the calls. So on the series, just select the 26, please. All right. So if we're getting out of this, the first thing we need to do is sell this immediately for whatever price we can get. I would not necessarily recommend using a market order, but you'd want to create a new closing order and then just unlock the limit price and send it for whatever the current limit is, so that you're avoiding slippage, but you're getting out right there.
Well, you avoid losing more than
Yeah.
you could. Like you could lose more.
Yeah, like if the limit price was 40 cents, you send it with a limit for like a sell limit order at 40 cents instead of just a sell market order and it gets filled at 25 cents because of slippage.
Yep.
So we'd want to do a limit order, but you want to do it quickly. And if it doesn't get filled right away, you'd want to drop the price another 5 cents in all likelihood to get that out quick. But now we would have just locked in a loss of about $2,000.
Mm-hmm.
What do we also have to do to cancel out the loss that we just realized from closing our primary long position?
You also would have to sell your short position.
Yeah, we gotta get out of the hedge too. So let's look at that. Let's see what that would be at that. And let's also compare the theta too of these. So like that one, -1%, the theta is 488 per day. All right, let's see what it is on the 29 Jan. Theta is okay. It's still negative because it's still out of the money. Like these puts, if it went down 1%, these puts would still be out of the money. They'd be getting near the money, but they'd still be out of the money. But we can see here that okay. The other thing that would be to your advantage in a way is that if it dropped a large amount on the open, the volatility would go up, which would increase the deltas of everything across the board. So that would actually benefit you.
Okay.
But the next thing we need to do immediately is once we've closed our primary position, we then also close immediately after that. We also close the hedge, because if you don't sell your short, then you're not benefiting from the purpose of it, which is to mitigate the risk of your primary position. We're not looking to make money off of these puts. In fact, in an ideal world, we would lose money on the puts 100% of the time.
Yeah, but you gain that
because we'd be profiting. We'd be getting the direction right, but we don't always get the direction right.
Right.
Now, I have seen Austin also. This is a little bit like a little fast and loose, but if you for example, this is 10 contracts on the puts. If you got rid of 8 of them, maybe you could do this, keep 2 on. That's sell your primary position, sell the calls. So in this case, 10 contracts.
Mm-hmm.
Sell 8 of the puts and then leave 2 on to just ride.
Okay.
And then he's had it where it goes in the money and expires in the money. So you can see that huge jump up of like, in this case, I think it's like 4,200. So if you got rid of 80%, yeah, that'd be like $840 of additional profit from the hedge. Like that it can be done. It can be done. Of like, if we open down 1%, and you can see where that is relative to the expiration P&L line. That's up other side. You see like that gold line. That gold line represents, yeah, right there. That's minus 1% of the S&P change. So if if we open there, what he might do is get rid of almost all of the hedge and just keep a couple contracts on, and then just look to like make a huge win, not a huge win, but a good size win, relatively speaking. Like, if you kept 2 contracts on and let them expire, and they did expire in the money, that'd be an $800+ win on a trade that was originally but you'd probably end up canceling out whatever you lost. I'll put it that way.
Right.
So that's something you can do, but
You'd eliminate your losses.
yeah, but also
Break even.
it would need to run a long way toward your hedge. For your hedge to be in the money, like the market has to move a lot, which that's not going to happen every day. Something else that has also happened to me is, if you would add back the Jan 26, is you get a big gap against you. Can you move the whole chart a little bit to the right? Not there. Yeah, just the whole chart. Just pull it over to the right a little bit. Thank you. Perfect. Okay. I have also had days where I did get an absolutely massive gap against me, and it would open it like on this, for example, 4,800, where it opens there.
Mm-hmm.
So what do you think I did?
We sold.
Just immediately dumped the whole thing, because
Like,
I was,
ASAP.
yeah, it's like I was so wrong about direction that I made money.
So even when you were wrong, you made money.
Yeah, like I'm looking for it to be like, in this case, I want it over 48.80. And it opens at 4,800, like an 80-point gap against me on the open. Like that's like, if
Pretty
you're
big.
long and you get a gap of 80 points against you, that's normally not a good thing. But in this case, it's like, okay, well, hey, I'm up, a couple $100 or $1,000, whatever. I'm just going to dump it and just move on to the next one, or dump this and immediately get short in a new position, shifted, one day further back in terms of expiration.
Mm-hmm.
So like, yeah, no, I mean, this is like, it's certainly clever in a way, like that it allows us to control the risk. And, going back to that whole idea of that these are random events with random and unknown outcomes, driven by the convictions of thousands of different people with competing ideas and beliefs and predictions, and competing objectives. It's just completely impossible to predict what's going to happen next, but it is very possible to control how much you gain if you are right, and how much you lose if you are wrong. That is the name of the game right there. Of just, operate like a casino.
Yeah.
The house always wins. So let's go back to the S&P chart. Let's see where it is now. It looks like it's up about 7 points from when we got into this. Let's go to SPX chart, Control 6. All right, let's zoom in on today. Oh, this is actually something kind of neat that it does. Can you pull down on the y-axis a little bit? Like click on the y-axis there on the right and just pull down on it. a little bit until we see that red line. Okay. So that's a cool thing it does. So it actually,
Orders.
it estimates based off of your option price where the S&P will need to be for those orders to fill.
It would need to be okay.
And
490-ish.
and those lines, you'll also see those lines will go down with time decay. So the further we get toward expiration, the lower those will gradually shift down to like 4910 and then 4900 and so on, which is another representation of, like I talked about, the purple line of representing open P&L merging with the expiration P&L of the blue aqua whatever colored line. So we can see here we are still above the high-low activator line. And we're looking pretty good here. Let's see what else we can do that would be good practice with this.
I'm just gonna use the bathroom real quick. I'll be
Yeah,
right.
yeah. Go for it. I'll pause the video, or maybe I'll put up like I'll screen share. All right. Here's what
Okay.
I'll do. This.
BRB.
Yeah, let me take over. We'll take a 5-minute intermission. All right. All right, just a moment, please. Let me just do one quick thing. Okay. Where is my? Oh, there we go. Okay. So ridiculous. Wait, how does the cat look with sunglasses? Hmm. You're muted.
Oh, okay.
All
I
right.
might have to jump like at past 4 for dinner. I'm gonna be going somewhere, I think. I'm not sure, but I might. I'll let you know.
All right. Sounds good. We'll just continue where we left off a little bit.
Sounds good.
Okay. I don't know when John will be. What time is it now? 3:17. I'm sure he'll be back fairly soon.
This is good, by the way. Like I feel like the way I like learn these things is like the first time I round, I'll probably like see the information and take it in,
Yeah.
and then probably the second time, even if I'm like repeating it, it kind of starts to integrate.
Yep.
Not fully integrated, but like it starts to integrate. And yeah, especially like the note taking, like I'll type and then I'll also handwrite notes, which is pretty good.
Yep.
And the visuals are good too, like the graphs you draw out.
Okay. Well, let me see here. Let me do options. Let me share a. Let's talk about. What did I go into? Let me just find that. Does this also make um, does this make sense? The wait, stop sharing. Like this of the amount of time decay that occurs the closer you get to the expiration. How these are
So-
like the same period, these are like 30-day periods, but it's like
it accelerates.
it's like this is like at least I want to say triple the amount of value lost over the same period of time, and then this is like another 3-4 times this amount of value that gets lost. Actually, that's another interesting thing we can add. You can go back and share your option chain, and we can look at a couple of interesting internal things that they have. Also, by the way, you can actually access paper money and see the trade that you just put on from your phone.
Oh, like on the app, right?
Yeah, you can just sign into
Okay.
paper money. You can watch that and see, how it's performing. Just it's a little bit more simplified. You don't have the same, risk profile graphs like you get in the Analyze tab here.
Definitely.
But basically, that's what I mean. Like you can see if you're winning or losing, and also, if you're working on a day that you have a position open, you can still close stuff. You can get out of stuff pretty easily.
Okay. Yeah, I'll do that after, and that'll be cool to look at throughout the day.
Yeah, so you can just monitor where things are at.
Mhm.
One of the things that I've found is that it's sort of like I almost feel like observing it changes the outcome, like the double slit experiment or something like that. I don't know. Like sitting and staring at this chart all day is not healthy.
Yeah, I don't think it is.
It will drive you a little bit insane. So it's like you need to have a balance between situational awareness and not like overthinking it, because the longer that you stare at this, like I think the way that people's brains work is that they want to extrapolate, like they want to find meaning in everything that they see.
Mhm.
When these little like ticks up and down and these wicks on this candle, like right now, that candle, that pattern. Oh, we should talk about candle. I'll go into that with John Luke when he's back. That candle is what we call a doji, which means that
This
it
one?
has, that means that the body, also the opening candle of today and the second open from the opening, are both dojis. Not that one. Go left a little bit, like that. Yeah, that's a doji, where
This
you have
one.
basically no body and long wicks coming out from both directions.
Yeah, so this one here.
It's basically a doji kind of deal. That, and what a doji, when you have the narrow body, so like basically the narrow body just means that the opening price and the closing price of that candle are basically the same.
Mhm.
And you had a lot of up and down. That's just representative of equilibrium in supply and demand, equilibrium in the number of buyers and sellers. So it's not moving really, but it's so easy. And I think it gets way worse when you look at a 1 minute chart. It gets so
More
much.
dojis.
No. It gets worse if you just sit and stare at a 1 minute chart, because you just get all this chop, all this crap that has zero meaning. It doesn't affect you in any way. And just staring at it, you're going to try to your brain will try to derive meaning from this data of these little moves up and down, when what we're trying to do really is simplify things. So like our trade here, we want to be over 48.80, and if we are below 48, our lower strike is 48.75 here in this case. So if we are below 48.75 by 10:30 a.m. tomorrow, we are out.
So, yeah.
We are out. We're done. And if we're above 48.80, then we just wait for the time decay to eat this away until we get our fills at our predetermined closing orders. So that's what I mean. Like that, we're trying to reduce ourselves from having any involvement in this process to strictly being the button pusher. Like
Yeah.
using, like in this case, and there's a lot of other ways that you can implement this on different time frames. By the way, this is just the 1 hour time frame. There's we're barely scratching the surface of what you can do with options. But this is just a super simple thing that works. So we're looking at like the high-low activator, and we use that to make a decision of long or short.
Hmm.
And then once we've made that decision, then we enter it. And when we're entering it, we're picking the strike that we enter based on the delta of both the primary position and the hedge. I sometimes also call them P1 and P2, where P2 is the hedge. So regardless of whether you're long or short, like if you're saying calls and puts and stuff and you're not sure, when you have multiple positions running across, 4 expirations at the same time, it can be confusing to say, oh, puts and calls, and all that, especially if you have opposite direction going on. So I will oftentimes use P1 and P2 just to keep it really simple and say like, okay, the nearest, the front expiration, P1 or P2, or the back expiration, P1, P2, to keep it kind of clear. But we use high-low to determine our entry price with the delta. The delta, like I said, with the entry, we want to pay for P1, we want to pay less than 250. We want to keep it at about a 50 delta. It's going to range anywhere from, a debit of like 220 to a maximum of 250. That's our entry price range for P1. And for the hedge, that's going to be at a 15 to 20 delta and a price no higher than about 65, 70 cents. And then once we're in that, then, for the first day, we let it ride. And then on the second day, we have, again, just very simple rules. If above X, then we hold it until either it starts to run against us, in which case, like for example, if this goes up tomorrow and then all day it's slowly dropping down toward our break-even point, we're going to want to get out at the break-even point.
Right. Minimize your loss or not any loss.
Yeah, just like, because if
Zero.
if the S&P in this case, if it opens, like we got in here, one of two things is going to happen tomorrow. The S&P is going to go up or it's going to go down. And if it goes up at all on the open, or it gaps up and opens higher than it closes, then we're automatically in a risk-free position immediately. Because if it gaps up, then we just say, okay, we let it ride. And if it starts to go against us and hits our strikes, and our strikes start to go out of the money, we just get out. We get out break even.
Mm-hmm.
So if it runs in our favor early on tomorrow, we're either going to get out for a break even, or we're going to get out for our profit targets. Those are the only two choices. Okay.
Okay.
If it opens or goes down initially, then there's, again, one of two things. By 10:30 a.m., we will have either closed for a loss, which we've already predetermined, or by 10:30 it will have gone up and have run in our favor.
So this whole thing is like, obviously know you can lose money, but there's this predetermined amount.
Yeah,
Where
everything's
worst case
predetermined.
scenario,
All of the outcomes are predetermined. Like we know what we're gonna do already if this goes down, and it's not like, oh, how much does it need to go down? What price do I want to get out if it does go down? It's like, it's very simple. Like the strike prices of our entry determine that. So if by 10:30 tomorrow it's below our strike prices, we're out. Done. If it opens in our favor and then starts to run against us later on in the day and it hits our strike prices, we're out for break even. We're done.
Mhm.
If it goes up and runs in our favor, we already have our exit orders set to GTC. Our closing orders are already ready to go. So if it runs in our favor, we just sit there. We don't do jack. Although one thing that I might do, just because it saves you some money, is, you know how we paid, what is it? Go to monitor again. I want to see what the fill
Commission?
price was on P2 on the hedge. What was that? 60 cents? Okay. Yeah. 60 cents. Yeah, right there. So obviously that's going to, in an ideal world, that's going to expire if we just let it run. That would expire out of the money and we would lose all 60 cents. What I would recommend doing is taking off the hedge as your closing orders get filled. So what that means is, like, when the 470 gets filled, take off two, maybe more, actually. You might take off more, but like once those orders start getting filled, you're going to want to, at the same time, start getting rid of your hedge. And the reason for that is very simple. Because if we start getting rid of the hedge, and like, let's say by the time we're getting fills at 470, 475, our hedge is dropped to 60 cents. It's dropped down to 10 cents. Well, if we get rid of the hedge, the puts, for 10 cents, in this case, like, that means our net cost was only $50 instead of $60 if we let it expire.
Mm-hmm.
And if it's 10 contracts times 10 cents, that's $100 that we're saving. Basically $100 that we're adding to the bottom line of our trade. So if we go back to the analyze thing, if we get, if it goes in the money, our overall position, so how we calculated that it would be about 20, like if we sell it at an average of 96% of max profit, we'd be making about 2,000. Like if we look at like where the, like at the, what does it say at the plus 1% line?
Yeah, a little under.
Yeah. All right. So if we sell our hedge, if it goes up to that point and we get rid of the hedge for, you know, maybe half of it's at 10 cents, half of it's at 5 cents, effectively we're adding $100, $75, whatever, to that number right there.
Mm-hmm.
By, you know, getting some of that money back. And that's also okay, because at that point, if we're that far in the money, the hedge doesn't affect us anymore. Because if we're that far in the money and it starts to go against us, we're going to be out at the break-even point anyway. Does that make sense?
Say it again.
Well, if we look at that S&P, like maybe scooch the whole graph a little bit to the left. Yeah. All right. There. If we look at that 1% line, that gold line. All right. If let's just say that, no, the other one. If we look at, like, that's what it's showing where it would be up like 900. All right. If we're up that far, you know, based on our rules of, if we're in the money, we're either getting out for one, our profit target,
Right.
or two, break even.
Mm-hmm.
So at this point, our hedge is no longer it no longer benefits us in any way, because our hedge only benefits us if the market goes against us.
Right.
But now it's so far in our favor, it doesn't apply to us anymore, because we're either going to get out for we're either going to be out for, again, our max profit or a break even at our strikes. So in this case, that would be like if the S&P hit 48.75, which will be that red dash actually on the blue line. Yeah, like right there. That's where if it opened way in our favor and then started going down, when it hits that spot, we're done.
Out. Sell.
We're out. So, if it opens in our favor, once we start getting fills on our closing orders, that's when at the same time we can start looking at getting rid of the hedge and trying to recoup as much of that debit of 60 cents that we paid as possible, because,
To break even.
yeah, the hedge doesn't help us anymore. The hedge is only there if we get a big run against us or a big gap against us on the open. That's its only purpose. So that instead of losing $2,000 on the open, we're only down 500 or 600.
Mhm. Yeah.
That's its purpose. But if we get a big run in our favor, it no longer serves any purpose. So we can get rid of it and get some money back for it. And that money that we get back is effectively adding to our bottom line.
Right.
Our P&L overall in the trade. So let's look at it's up at 87 now. All right, let's see how our theta has changed. Okay, our open P&L on this position is now, it's gone, the market's gone about, from where we got in, it's gone up about 10 points.
Over what, like an hour?
Yeah, something like that.
Roughly
And you
an
can
hour.
see that our open P&L is 700. If this was one contract, which is where you'll probably start with, that would be about 70. Well, now it's showing 500 open P&L. Okay.
50-ish.
Yeah, that'd be $50.
70. 50, 70. Yep.
That'd be $50. So and it's just about repeating the same thing over and over and over, as many times as you can, until you are really just the whole point of this is that it should get extremely monotonous and boring, of same thing every day. Check how, okay, we're in an uptrend, look at the trend, look at the trend side. Okay, we're getting long today, we're getting short today. 50 delta entry on the primary position, P1, 20 delta entry on P2. Make sure the position sizes are correct. Send it. Set up closing orders to take profit if we're right. We want it to be as systematized as possible so that there is no possible role for our emotions to interfere, where every aspect and every possible outcome has already been determined.
It's been accounted for. Yeah.
Before we've even opened the position. So we don't need to feel anything.
You've set up your safety nets.
Yeah.
So there's no fear of falling beyond that safety net.
Yeah, you got your safety nets, you've got your targets, you've got everything in between. And it's all already we've already decided everything. And based on the limit prices too. The other thing that's great about options is the fact that with verticals, they are limited max profit, limited max loss positions just by their nature. So North Korea could nuke itself or whatever tomorrow, and the market, goes hits a circuit breaker and drops 7%. Well, okay, let's say we were long and the S&P went down 7%. Let's see on this position here. What would that look like? Where would that be? Yeah, you can just drag it over to the right a little bit. Or no, actually just change the -1%. Just change that to -7%. And let's just see what the open P&L would be. Oh, look, it's exactly the same.
Why is that?
Well, go scrunch the chart up a little bit. Pull it to the other way. Yeah, to the left, I think. All right, now pull the whole chart to the right. And scrunch it up a little more. Pull to the left, yep. And let's just keep scrunching it until we see that 7% gold line appear to the left. Yeah. All right, so now we're seeing the S&P prices at the bottom are in 50-point increments. All right, now go right, like pull it to the right, the whole thing. All right, there. That'd be like if the S&P went down 7%. That's basically just because it would be giving us max profit on the hedge, which is like $4,200 of profit on the hedge against $2,000 that we'd lose on the primary.
Mm-hmm.
So even in like the worst, if we were long in like the worst possible market meltdown ever, which like I
Rarely
actually
happens.
had this experience like when Russia invaded Ukraine.
How much was it when Russia invaded Ukraine?
There was one circuit breaker, so it was 5% in a day.
Okay.
But it would be the same thing. I mean, you can change it to minus 5% down there. Let's see what that would be. Okay, yeah, same thing, same difference. So it's like when things would normally be really, really bad for everyone else, with this, it's like, well, okay.
I mean, that's pretty bad, and it's still like 13%,
Yeah,
negative 13%, and it's still
it's the same number as our max profit. See what I mean?
That'd
This is kind of
catastrophic.
bending the rules.
that'd
Bending
be
the
catastrophic.
rules. Yeah, oh yeah, that'd be well, yeah, but not for you.
No, exactly. But in general, it'd be catastrophic. But here, it's still
Don Luke, how are you,
not
sir?
too bad.
I'm doing fine. I think they just had to move everybody's appointment to the same day, so it was kind of backed up. I don't know. That's kind of unprofessional. I think I might find a different doctor. Just out of the blue, move my appointment to the next day. What if I wasn't off today?
Yeah, that's true. Well, we're talking about risk profile, but Jonathan, I think you can probably see that this is bending the rules sort of how option pricing is supposed to work with respect to if you want more probability, you have to if you want a higher probability, you're going to have to sacrifice profit potential. And if you want more profit potential, you're going to have to sacrifice probability. This is really kind of this is a little different, especially because of the fact that we can be so profitable even in a catastrophic circumstance. And obviously in a catastrophic circumstance, if we had the opposite of this position, if we were short, well, you know, then we're short and we'd make money anyway. All right.
That's pretty catastrophic. I'd say that's catastrophic.
Yeah, 100% decline in the S&P. That'd be a bad day. But it doesn't matter.
Because we'd all be dead.
For us. Up is good, down is good. Doesn't matter. All right. Okay, now we're at 85. What is our let's reset the slices and see where we are now. Also, I want to go back to the chart and let's see how much those fill orders. I bet they're now below.
Reset slices first or the
yeah, hit that. All right.
No.
Now, if we go to the chart, I'm going to guess that those things are now below 49.10. They're getting pretty close. They're getting close. See, that's like just the time decay. So right now, we just want to be above 48.80.
which is around here. No, here.
Yep. That is our number to be above. If we're above that, we're good. If we're below that, we might lose some money, but we're also good.
You're still good, yeah.
Now, I would like to do the coin toss experiment. I'll get a coin toss app, or they have it on Google now. Let's go back and look at the last. You can do it from your chart, Jonathan. let's use like the entry, like the opening. Let's look at the last like 30 days. Oh, since we changed the yeah, let's look at like from 1 to, yeah, let's look at the start there. Let's start January 1st. All right. So let's just use the entry of one day, like the opening candle of one day to the closing candle of the next, like the time of the closing candle of the next day, to like 4 p.m. the next day. Can you get the drawing tool out? Price level, $sign with a line. Do you remember how to do this?
Yeah, it's like you tap and then you.
Yeah, let's go to the opening
On the
of that
same-
day, of that Tuesday, right there.
Okay, Tuesday. Where's the time?
The open.
9.
What was the open? Top of that red. Yep. That would be the open of that candle because it's a red one. Top of the body. All right. And then just move it over from there.
What's this red line?
Oh, right click on it. No, you left click. All right, let me let's just move the mouse. Never mind. We don't need to draw lines. Just get rid of them. You got to right click on them if you want to get rid of them. You can just move the mouse. Let me just get a piece of paper and write down like win or loss. Charlie, this is just an experiment that we're doing to see if the strategy that we use for risk management, if you could actually use a coin toss to determine whether you go long or short and still make money.
I mean, wouldn't that drop the odds to 1 in 4?
No. It'd still be 50-50. All right. Let me just write like when plus. All right. So let's just put the mouse on the opening candle of that Tuesday. Just put it there so we can just see like, okay, so the next day it went down. All right. So let's say heads is long and tails is short. Sound good?
Okay.
All right. So flip again. Tails. All right. So the next day it went down. So that's a win. All right. Now move the mouse to the open of the next day.
Wednesday. Open there.
Yep.
Thursday.
Tails.
Open here.
It went down. So that's 2 wins. All right. Thursday that we would get in short. Tails. So that would be a loss because it went up for the first 2 hours.
Okay. Friday.
Friday, that would be a short. Or the market is saying short, but that's a head. So we would be entering long on Friday. So that's a win.
Okay.
Next day,
Monday. Open here.
that would be it says the coin was tails. So that would be a loss. Next day,
Tuesday. Open here.
heads. So that's a win. Next day is
Wednesday.
tails. So that's a loss. Next day, Thursday, open was way up. No, next candle over. No, back. It's the top of that one. You see there? That's 10. Go to 9 a.m.
Oh.
There you go. Yeah. So the
Yeah.
open
This one.
was-
Oh, okay. In the middle.
All right. Let's flip again. Tails. Okay, that was a short. So that one would have been okay. Next day, open was, yep. Heads. That would have been a loss. Next day, heads. That would have been a loss. Next day, tails. So we would have been short. That would have been a loss. Next day, that would be heads, and it went up, so that was a win. Next day, heads. Okay, so that's a win. Next day, tails. So that would be short. And, you know, with how fast that opened and then the way that it went down the next day, that's iffy, but I'm going to put that in the loss column just to keep it fair. All right, next day is tails. So that was short and we'd be wrong there. The next day after that was a short and we would have been right about that. And then now we're at the present day. Okay, so that is exactly 5, 6, 7, 8 wins and 8 losses.
8 wins, 8 losses. That's interesting.
8 wins, 8 losses.
That's pretty wild.
So, and given the 2-to-1 risk reward ratio, yes, if we were picking our entry, whether we go long or short, off of a freaking coin toss, yes, we would have made money.
That's pretty wild.
That's insane.
That's
I'm going to
pretty
try
wild.
that at some point. That's hilarious.
That's pretty wild. That's some witchcraft.
The first time I described it to John Luke, he called it the infinite money glitch.
I mean, hey, it could be. It is.
Well, go to trade. Let's see how much liquidity there is, though. I don't know about infinite. I'll scroll all the way down, close the option chain there, like shrink it, that date. Scroll all the way down. Now go to today's option statistics. Right there, yeah. All right. How many were sold?
What's this?
And it shows the deltas. Okay, so we have 5.2 million contracts bought and sold today. And look at the delta. See, it says delta between. So we can look at like between 40 and 60.
Oh, here?
So that means that you can see where most of the volume is. So on the calls between 40 and 60, it's almost 500,000 contracts.
Half a million contracts in one day.
Oh yeah. Now go back to the Jan 26 expiration. And John Luke, don't worry. I'm going to explain everything that we're looking at in short order. Okay. Now we can go to volume and see where's the volume there. 5,000 and 3,000, like between them, the strikes, see volume? It's
Yeah,
just
here.
that strike.
Here?
Yeah, that column. That's the volume column. So we can see like it's 5 and 3,000 contracts. We trade this position that would make you $2,000 is 10.
Say it again.
This position that we've set up that would be
Mhm.
a hypothetical profit of over $2,000.
Yeah.
That's 10. What if you did 1,000? What would that be?
This is 10, 2,000.
It'd be 100x.
20.
So from going from 10 contracts to 1,000 contracts,
Yeah.
it's 100 times 10 times 2,000.
Oh, 200K because it's the 2,000
Yeah. Like that'd be
200.
completely doable
in a day. Or not in a day, but
in a day.
200,000. That's pretty wild. Not
Yeah.
gonna lie.
Now, I'm going to do the coin toss thing, dude. That's freaking cool.
You seem really intrigued by it.
No, because it's so funny. Because it's like I'm looking at this, and it's like we clearly would have been right exactly half the time, which makes sense in a way. Because 50 delta, 50% probability. Coin toss, 50% probability.
What's your trading strategy called? It's called the coin toss strategy.
Well, this really goes to show something that's very important. Fundamentals. Remember Jim Cramer? Oh, we got to show John Luke Jim Cramer.
I think right.
Our boy.
That dude's a meme nowadays.
I've seen him before.
He's a freaking idiot.
He's a meme. It's like hey Rosser, after like in 10-ish minutes, I'm gonna have to jump. Just letting
All right.
you know.
Yeah, you're good.
Oh, it's
You're good
perfect.
to see. Now that we've talked about the price action again, we reviewed that one more time. This will actually probably make more sense.
Oh, his whole when he's like explaining like, oh, you hit them, you do this, he's like admitting all these.
Oh, this is right. I'm gonna take over.
If you haven't seen it yet, take a look at it in some rare video clips with Jim Cramer from 2006, where
This
he
is
reveals how
amazing.
hedge
All
funds
right,
can
shut up.
manipulate stocks to reach whatever goal they do. This is important and understand exchange.
Oh my Okay, here we
You'll
go.
enjoy
Sorry.
this rare video, and
The
I'll see you in
retard
the
had
next one.
A lot of commentary.
Welcome to Wall Street Confidential. I'm Aaron Task, joined again by Jim Cramer. Jim, welcome.
Good to see you.
Thanks for being here. There's a lot of economic data out today, but I want to talk about something else first. Again, today we have the misdirection from the futures. The futures pointing to an up market, and as of right now, stocks are down again. Is this just because it's the holiday period that we're seeing this?
You know, a lot of times when I was short at my hedge fund and I was positioned short, meaning I needed it down, I would create a level of activity beforehand that could drive the futures. It doesn't take much money. Similarly, if I were long and I would want to make things a little bit rosy, I would go in and take a bunch of stocks and make sure that they're higher, and maybe commit $5 million in capital to do it, and I could affect it.
You see what he said there? Do you follow that?
Yeah.
Said,
Makes
I,
things
said
rosy.
if I'm long and I want it to look a little rosy, I take a bunch of stocks, commit 5 million capital, basically getting rid of opposing supply and bidding it higher. If he has large long positions where he wants things overall going up.
What you're seeing now is it probably is bigger market now. Maybe you need 10 million in capital to knock this stuff down, but it's a fun game and it's a lucrative game, and you can move it up and then fade it. That's often creates a very negative feel. So let's say you take a longer term view intraday, and you say, listen, I'm going to boost the futures, and then when the real sellers come in, real market comes in, they're going to knock it down. That's going to create a negative view. That's a strategy very worth doing when you're valued on a day-to-day basis. And I would encourage anyone who's in the hedge fund game to do it because it's legal,
Right.
and it is a very quick way to make money and very satisfying.
Okay. Well,
Oh, by the way, no one else in the world would ever admit that, but I could care.
that's right, and you can say that here.
I can't. I'm not going to say it on TV.
Well, on a related note, there's so many more hedge funds today than when you were
Right.
managing your hedge fund.
Right.
Do you think that does that exacerbate the moves, or does it make it
Well,
tougher?
you know,
'cause there's-
the hedge funds are positioned long short, okay, not just long like mutual funds. So it's really vital these next 6 days because of your payday. You've really got to.
What are we positioned when we get in? Regardless of whether we have a long bias or a short bias. Jonathan?
What do you position when you put in?
Yeah, he says hedge funds are positioned long short.
Mm-hmm.
It's the same thing we're doing. We might have a bias toward the long side or a bias to the short side, depending.
We always put in.
but we're
What's that?
always positioned both long and short.
Yeah, you do the two, or like we were doing all the
You
contracts.
can't let it lift. When you get a research in motion, it's really important to use a lot of your firepower to knock that down because it's the fulcrum of the market today. So I mean, let's say I were short. What I would do is I would hit a lot of guys with RIM, Now you can't foment. That's a violation of
Ferment?
Yeah, you can't foment. You
Foment.
can't create yourself an impression that a stock's down. But you do it anyway because the SEC doesn't
Right.
understand it. So I mean,
And let me back that up one more time.
guys with RIM. Now you can't foment. That's a violation of
Ferment?
Yeah, you can't foment. You
Foment.
can't create yourself an impression that a stock's down. But you do it anyway because the SEC doesn't
Right.
understand it. So I mean, that's the only
That
sense
was a
that I would say
very
this is illegal.
dumb-
But a hedge fund that's not up a lot really has to do a lot now to save itself. So this is different from what I was talking about at the beginning, where I would be buying the Qs and stuff.
Right.
This is actually just blatantly illegal. But when you have 6 days and your company may be in doubt because
actually
you're
illegal.
down, I think it's really important to foment. If I were one of these guys, foment an impression that research in motion isn't any good because research in motion is the key today. So you would hit this guy and that guy, and when you would see an offering, when you see a guy who's bidding, you'd wipe out that guy very quickly. And what I used to do was called, if I wanted to go higher, I would take and bid. And if I wanted to go lower, I'd hit an offer. And I could get a stock like RIM for maybe, that might cost me 15, 20 million, Annie, to knock RIM down. But it would be fabulous because it would beleaguer all the moron longs who are also keying on research in motion. So
There's a lot of
we're
that going
seeing,
on today with
yeah,
RIM,
we're seeing that.
absolutely.
That's, again, when your company's in a survival mode, it's really important to defeat research in motion and get the Pisanis of the world and the people talking about it as if there's something wrong with RIM. Then you would call the journal and you get the bozo report on research in motion and you would feed that there's a Palm's got a killer it's going to give away. These are all the things you must do on a day like today. And if you're not doing it, maybe you shouldn't be in the game.
Okay. Another stock that a lot of people are focused on right now seems to be Apple.
Yeah,
You
Apple's
mentioned-
very important to spread the rumor that that both Verizon and AT&T have decided they don't like the phone.
Right.
That's a very easy one to do because it's also you want to spread the rumor that it's not going to be ready for Macworld. And this is very easy because the people who write about Apple want that story. And you can claim that it's credible because you spoke to someone at Apple because Apple isn't in it doesn't
Right, they're
issue
not
any
gonna
statements.
comment, they're not gonna
Right, so it's
say.
really an ideal short. And I would, again, if I were short Apple, I would be working very hard today to get that. And the way you would do that is you pick up the phone and you call 6 trading desks and you say, listen, I just got off the phone with my contact at Verizon. And he has already said, listen, we're a Lucky G house. We're a Samsung house. We're a Motorola house. There's no room for Apple. They want too much. We're not going to let them in. We're not going to let them do what they did to music. And, I think that's a very effective way to keep a stock down.
Right.
I might also, by the way, because the stock at 84, 85, a little bit of capital, you go buy some January 80 puts that makes it look like there's going to be something going on. So maybe you give Morgan an order to buy 1,000 Jan 80 puts, then you go position limit with, you use a firm that doesn't know what the heck it's doing. Maybe you go to UBS for puts. And you just kind of create an image that there's going to be news next week, and that's going to frighten everybody.
Right.
Then they all go out and say large put buyer UBS. Then they call Pisani again. You have to use those guys and say, listen, I see a big buyer of puts, and I'm told that it's SAC. You would do that too. And these are all what's really going on under the market that you don't see.
Right, and nobody else talks about it
Right,
except
but
you.
what's important when you're in that hedge fund mode is to not do anything remotely truthful, because
Not do anything remotely truthful.
when you're in that hedge fund mode is to not do anything remotely truthful,
This is
because the truth is so against your view
Right.
that it's important to create a new truth to develop a fiction. And the fiction is developed by almost anybody who's down like 2% to up 6% here. You can't take any chances. You can't have the market up any more than it is if you're up 6. Because starting Jan 2, you'll have all your money come out. So
Right.
what would you do if you're in that situation and you feel like you're desperate? Is that you would do these actions?
So you're talking about the mechanics of the market.
Well,
You know, the-
mechanics are much more important than the fundamentals.
Oh, okay, well, but in terms of the fundamentals, you've been writing about how you
Who cares
think.
about the fundamentals? Research in motion just blew out the.
that. Who cares about the fundamentals? Like, so many people are so focused on will be very focused on, and for long-term investing it does matter, like long time frame, 10 years, however long, if you're buying stuff to hold for your life, like dividends, whatnot, then yeah, like you want to get good companies with good earnings and good CEO, and you look at the different, like the dividend yield and the this and then that and the quarterly earnings and the earnings per share and the PE ratio and that kind of stuff. Sure, But what he's saying is that, like, in the intraday kind of game, like what we're doing here, what we're talking about with options, he just said that that was so important.
Oh, okay. Well, but in terms of the fundamentals, you've been writing about how
Who
you
cares
think.
about the fundamentals? Research in motion just blew out the court.
Right.
But look what people can do. I mean, that's a fabulous thing. The great thing about the market is it has nothing to do with the actual stocks.
Right.
Now, look, over
The great thing about the market is it has nothing to do with the actual stocks. Isn't that an interesting perspective
Pretty wild, yeah.
from a guy who's actually like at the time was actually like jacking stuff, up and down using the price mechanics that we talked about effectively of buy limits and sell limits, bid and ask.
maybe 2 weeks from now, the buyers will come to their senses and realize that everything that they heard was a lie. But then again, Fannie Mae lied about their earnings for $6 billion. So,
Right, and Bristol Myers
it's just
lied,
fiction
yeah.
and fiction and fiction. And I think it's important for people to recognize that the way that the market really works is to have that nexus of hit the brokerage houses with a series of orders that can push it down, then leak it to the press, and then get it on CNBC. That's also very important. And then you have a kind of a vicious cycle down.
Right.
And it's a pretty good game. And it can be played. You pay for a percent or two.
Right, and then do you get long before Macworld and the expectation that the
Well, yeah, because
iPhone
you
is
drove
going to
it
be
down.
good? Right, and then you go
Well,
back,
you
flip to the
certainly
long
got to
side.
use the other side.
Interesting.
Yeah, and there's a
Do you get what he said there?
He said use the other side. I don't know exactly what he means.
Well, he's talking about after you've short sold something and you've knocked the price way down. And then the guy said, well, then do you get long? And he said, yeah, well, you got to use the other side. So it's like you knock it down, cover your short position. So like that means you buy the bicycle back and return it to the broker. And then you go long. You want to gain from it. So he's talking about using the other side of after you've knocked something down, then you take profit on a short and then you push it back up. And again, I would emphasize like that whole line that he's like when he said the market has nothing to do with the actual stocks.
case where I would say the January 80 puts can be justified because after I've knocked the stock down to 80, I can buy a lot of common. And then you play it right into Macworld where they'll probably introduce the phone and Verizon's going to take it.
Okay. Well, maybe the fundamentals don't matter, but let's talk about the
Well,
Fed
remember,
a little bit.
what Wall Street Confidential
Yes.
is not giving you the party line. Oh, here's the
Right.
party line, by the way. I spoke to Apple. The phone, I hear the phones are good, and Verizon might take it. And as a matter of fact, the research in motion sellers, I don't think they know what they're talking about.
But you've been writing about the cell phone market. You think you don't want to
Well,
be involved in that.
the problem
right?
with the cell phone market, frankly, is that these guys are all killing each other.
This was
Someone has to
2007.
take a dive. Motorola and Nokia have to get in a room and just fix price. They've been reluctant to do that because of the various justice departments and because they
And it's
actually
illegal, right? Yeah.
Well, that hasn't stopped a lot of other companies.
This is true.
This seems to be a case where they seem to be directly worried about the authorities. It's almost as if they have a lawyer that matters, unlike, say, the Bristol Myers lawyers. And, what eventually happens is the shareholders demand that you get phony lawyers and you sit in the room. And it'll happen soon.
Real quick, the Fed, the numbers out today weaker than expected.
Oh, so what? The Fed has obviously got a cut. But,
They've got a
again,
cut.
you call the various guys who cover the bonds and you say, ignore the bond action. What's really happened is the Fed is very frightened about, and then you gin up the number that they're really frightened about. The Fed is actually desperate to try to figure out, how quickly they have to cut without looking like dopes that they raised
Right,
in
because they've
May.
been talking about they're worried about inflation all this
You
last
don't
few
want
months.
to. You don't want to raise in May and then cut in January. You look like Mexico, for heaven's sake. I mean, this is like a distinguished group of people who went to really good schools.
Right, these are smart guys. Absolutely.
Yeah, they don't want to look like dopes.
But when we were talking earlier in the week, you said you think it would be some sort of crisis, possibly Ford being a trigger.
Well, Ford went and did all that, they pledged all this investment banking to all these guys. So now that they're very reluctant to say negative things, it makes it much tougher for the Ford story to play out. I mean, the amount of business that Ford has to do. Ford might be the big client of 2007. So if I were in the corporate finance room, I would say, listen to the research guy. I said, listen, I spoke with Mullally. I actually have the inside. The plan works. So then you're the research guy and you say, oh, man, what do I do? It's bonus time. I'm not going to be a total idiot. Spitzer's going to Albany. Let's get back in the game.
Right.
I think that's important.
Is it possible? Because a year ago at this time, a lot of people were saying GM's about to go bankrupt, and of course the stock's up 50 some odd percent.
Well,
It's just, could Ford be
they're,
that stock?
they're
at 57,
GM. No, but
57?
GM. The difference between Ford and GM was that GM's balance sheet was never really. It turned out wasn't that bad. Ford's balance sheet's pathetic, and you know that because they were willing to screw over the common for the bonds.
Right.
That's kind of if it weren't Ford, if this were Qualcomm, we'd be saying Qualcomm is desperate, you know. But no, it's Ford.
But it's
so we
Ford,
say
it's an
Ford.
American
Yeah,
icon,
I
and
drove
so-
a
right.
Ford. You know, I owned a Ford once.
And this is our country. Well,
Yeah,
this
right.
has been Jim Cramer. Wall Street
Again, you know,
Confidential.
what I'm trying to go for in the Wall Street Confidential, and I'm not saying you're sending me. I have to talk about what it's like at my hedge fund, okay? Because and what other hedge funds do, because the difference is that if this is an intraday show, and you need to know what I know is going
Right.
on. Now, we step back. Research in Motion was a real blowout quarter. It was a really good quarter, and I was quite surprised how strong the margins were. It looks like the other guys have really dropped out. It's a terrific story. Should it be up 6? Yeah, I think so. But, you know, look where we are. It's Friday. You know, you got 5 more days to make your quarter.
Right.
Can you really risk having RIM up this much? I don't think you can.
Okay, and they're not. And if I'm correct, you're off next week.
Yes, I am.
Okay, and
But,
I am
you
as
know,
well.
right.
So we'll be back in 2007.
I'm hoping that we
more of
get
this.
that we finish the year at 1260 because that's at 12,460 because that's what I said at the beginning of the year was. Now yesterday we came in and we were 20 points away from what I predicted. You know, I want to nail it.
Do you have a forecast for 2007?
Yeah, but I'm not.
You're
It
gonna
comes
save
at, it's over a series of 5 days, so people have to go
All
to
right, people,
realmoney.com.
check it out on realmoney.com. And Jim, thanks very much.
All right. So that is an amazing interview that goes into a lot of the stuff that's just so against the conventional wisdom of how these things are all supposed to work.
That's 2007. That's what? 17 years ago.
That's wild.
17 years ago.
But yeah. So, Jonathan, when you left, where do we leave off? Jonathan, you need to hop in.
Yeah, I'm gonna hop. I'm gonna be going to
All right.
dinner.
I'm gonna end this recording and then start a part 3 of the day, and we can go into options. And then, John, will you be good for about another 2 hours?
Yeah, I'll be good. When you take a pause, I'm gonna go use the bathroom real quick. And I'll be
All right.
back. But it was
Well,
good to meet you, Jonathan.
You as well,
have a good rest
likewise.
of your day.
Well,
Thanks,
gentlemen,
thanks, you
it's
too.
been, really great, and I will stop recording in 3, 2, 1.